Saurabh asks if now is a good time to invest in debt funds since their value has come down recently.
Don't do that, because it's not a rally which has come down. In fact, everybody has been wrong. So as I keep suggesting, that the only way to not get disappointed with by anticipating these situations is that uh, align your investment, fixed income investment, debt fund investments with your with a reasonable time frame of your investment. If this is your long term money, then by all means be in a conservative debt fund. That will generate reasonable return. And at some point, I don't know, because the RBI governor has been very explicit in his statement that it is going to be a status quo, and everybody anticipates a rate cut. And I would rather say that don't go with the fund manager's expectation or with the RBI's statement. Go with what is in your control. Money for few days, don't take any chances. Money for few weeks, let it lie in a fund which is insulated from this risk. And if if you have long term money, 2-3 years money, choose between income fund and short term and fixed maturity plans, depending on your risk tolerance, or depending on your liquidity needs. I think income funds will produce reasonable return, very much in line with what the current rate is, irrespective of ups and downs, irrespective of the upheavals in the market. Make sure that you are one thing which every investor should be careful about, and they should look at this particular fact, that a fund is not taking undue credit risk, because that is something which disappoints investors most, when your fund in particular takes a hit because some company has defaulted on the interest payment, or has deferred the interest payment, or repayment of principal. This is a situation which investors should avoid, and the way to avoid is come to Value Research online, check for the fund that you want to invest in, look at the allocation to lower rated bonds in the portfolio. You must do this check before you make that investment, and if you find that to be 15-20% and more, keep away from that. Let other investors make their money, make little more, because when you make little more when you earn little more in debt fund, it is not as much, but when you take a hit, it is substantial. Taking a 5%, 10% hit on your debt fund is very disappointing, and the upside of some of the risk that you assume is very low. So I feel that in debt fund, taking a significant credit risk, is the risk return trade-off is not in favor of an investor. They should keep away from that.